next candle is the up candle, so we start looking at the range between this up candle and this up candle. Between those two up candles, there's what's referred to as a fair value gap. Okay, a fair value gap. The reason why this is important is because there was no up candle or up movement between the break of that low and the high of this candle here. It was all just straight down movement. So nothing filled in this area. Once price broke this low, it left it open. Basically, it's like a gap. The same thing occurs here when this up candle is broken here on this candle. Once it started breaking lower, there's a gap between this candle's low and this candle body or wick. Okay, so I define it by the body. I like to use those. The range in which it causes this void, okay, when price is below that, this is going to be fair value. Okay, the market's going to want to come back to that because there was very little trading in there. Just like we said, there was a gap because there was no movement up in this area here between this up candle's low and this up candle's high. This area in price action only saw down movement. Didn't have any up candle movement, only down movement. All this down here is down candle price action only, big ranges. So this is a liquidity void. The fact that it creates it in big ranges and speed, that's what defines it. Now, because price moves so quickly in these areas, fair value is established because there's going to be a willingness to want to see price trade back up into these levels in here and close in all this. In other words, there's going to be up movement later on. It won't happen immediately always. Sometimes it takes a little bit of time. Sometimes, depending upon the time frame you're looking at, it may take a great deal of time. But when price starts to move higher, we know that we'll try to trade into this range here and fill that in at a later time. That is where market makers view fair value. Now, equilibrium, or fair value in regards to equidistant range between high and low of a defined high and low range, that being if we have this low here and this high here, if we define that with fib, okay, we have equilibrium right here, or 50% of that range from this high to this low. There's equilibrium. Okay, look how the bodies of the candle stay above that, but we have a lot of work around that equilibrium price point. That in itself is significant because it's showing you that the market ran through a short-term high. Once it ran through it, it came back down, right back to the middle of the range, or fair value, which is equilibrium. At this moment, price could stay in this consolidation for a period of time of any length. We don't know how long price is going to stay in a consolidation. But at equilibrium, you need to refer to where the most recent price swing took place. In other words, if we're at equilibrium here or at fair value, the market can go either way at this price level. The easiest way to determine where its most probable direction is where did market structure break most recently? Did it break a swing high or did it break a swing low most recently? Well, there's no swing low in here of any significance, but there is a swing high up here that it broke through here. So when we made this low, price ran through it, clearing out these highs right on this up candle. Price come back down into equilibrium. Do we define the range from here to here? As you're looking at price, you always want to get a feel for where you're at in regards